tech stocks. Not only do you have them going up to Capitol Hill to testify, but you've got the big names, Apple, Alphabet, Amazon, and now Facebook, all reporting on a single day on Thursday. And considering that they have been the engine that has driven the market, certainly an important week to watch. We've got Kathryn Rooney Vera joining us from Baltic to talk about this. Kathryn, am I overstating the importance of watching tech this week?
Oh, this is an important week, Amber. I think you nailed it on the head, and I was actually taking notes when you spoke. The fact is that the congressional hearing is a huge thing to watch. And on top of that, earnings on Thursday is critical. This week, we also get some very important economic data out from the U.S. in addition to the Fed meeting. So this is a very important week. And I think that probably the most important thing is going to be what we hear on the fiscal and monetary stimuli fronts. That is what arguably has taken the market to these soaring heights. And I think that's going to be what continues to drive further upside.
What happens? Let's talk Wednesday first, the testimony. What could come out of there that could derail investor confidence? Because in many ways, we've seen this before, right? We've had this conversation before. We've had this conversation in Europe, and then sometimes we have this conversation in the U.S. as well.
Sure. No, you're completely right. And I don't think anything could come out Wednesday that will derail the markets. But what could derail the markets is November 3rd, the blue wave really sweeping the Congress and the White House. So if, in fact, we do get a Democratic House, Senate, and president, given their emphasis on antitrust issues and heightened regulatory issues with these behemoth tech names, then I think that the market is going to respond in kind.
I thought it was interesting that Facebook moved their results to Thursday, one day after the testimony. I'm sure they didn't want to have a fresh batch of financial results for Congress people to munch on in front of the nation. But on those results, I mean, we're used to double-digit growth numbers for a company like Facebook. But when you look at the estimates, maybe 5% growth, they're also not immune from the COVID pressures. But they're still getting the benefit of higher stock prices and higher valuations.
No, that's very true. And I'll add one point to what you mentioned, Amber, is that tech is now a defensive name, or has historically been in this recent pandemic. Tech has outperformed both in the up and the down markets, and tech has, as everyone's been talking about it, this phenomenon has just taken the impact of tech on our lives, accelerating it forward 3 or 4 years. So certainly tech is necessary. We're talking right now, rather than me being in studio, I'm here in the comfort of my own home. So there's a lot of tech is really invaluable at this juncture. And I think it's both a cyclical and a defensive, which is phenomenal in its nature. I do advise, however, that we are at extended valuations. I think the market is pricing in the most rosy positive scenario possible. It's euphoric in nature. I think greed is at heightened levels. And the fact is that if you look since 2017, it has almost uniquely been 5 names, not just the tech sector, Amber, but 5 names that have been responsible for the entirety of the market surge.
So what do you do then as an investor? Do I think, well, this is invaluable, as you said, so I'm just a buy and hold, and there's going to be negative things that happen, but fundamentally I'm sticking with it? Or should I be valuation conscious?
Well, that's great. I think kind of, I hate saying both, but it's true. You should be valuation conscious, but we're in a whole new ball game here in the sense that the Federal Reserve is backstopping the entire market. So if we do take a dip, the Fed is just going to buy additional assets. The Fed is currently buying not only treasuries and mortgage-backed securities, but investment grade and below investment grade corporate bonds. What's to preclude the Fed from doing what it did with U.S. high-yield bonds with equities? In other words, creating a structure managed by BlackRock at the Treasury through which it can buy equity ETFs. So I think that we need to be invested. And despite extended valuations and the risk of a W-shaped recovery, one has to play on the Fed. The Fed is perhaps one could argue manipulating the markets, right? Keeping treasury yields exceedingly low and fomenting this surge in equity prices. We want to be in that. We don't want to exit and miss and have that opportunity cost.
What's the risk? Because if you say the Fed is the backstop, what is the risk if these tech stocks do falter to an investor who, owns the S&P 500 just broadly, takes Warren Buffett's advice, buys the ETF, and just lets it ride? Given the concentration and how important these stocks have become, what's the consequence to the overall market?
It's 25% is the consequence. And when 25% is the composition of tech in the S&P 500, slightly more. So if you get a dive in tech, then you get a dive in the S&P 500 by definition. So if one is positive and thinks that this is certainly nothing but up in a V-shaped recovery, both economic and market-wise, then he or she would want to diversify their investments and follow and invest in those sectors that have heretofore not skyrocketed like tech has. So you would look at financials, you would look at energy, you would look at industrials, material, you would look at utilities, you would look at the sectors that have pulled up the rear.
And those, the ones that you mentioned, I imagine, and we did see this, do well in a reopening, right? The financials, certainly battered in the initial phase of COVID, do well in a reopening. How closely are you tracking the case counts going up in certain states? And does that affect how you think about those, so-called reopening stocks?
Well, I think the V-shaped recovery could become a W-shaped recovery, and we could be on the precipice of that third tranche of that W form if, in fact, these new case counts bring about an economic closure of the most important revenue-generating states and value-adding states. So if Florida shuts down again, California is already virtually shut down. If New York, Chicago, see, if we get a renewed economic shutdown, then this does take us lower in terms of a consumption-driven economy. That's one perspective. The other thing to keep in mind is even if we don't get economic shutdowns, but the fear of a second bout or an extended first bout of the virus impacts consumer confidence. In an economy such as the United States economy, that's 3/4 consumption based. If you get a collapse in consumer confidence and a subsequent drop in consumption, then you by definition get that double dip recession. So I think that the new case count and is something to watch, not just for the virus impact, but for the economic and consumer confidence second round effects.
And just last question, I hear you saying that there's fundamentals underpinning not only the rally, but also the sector that has been the leader, tech. If I wanted to take the other side, if I wanted downside protection, what sectors would you look at adding to in terms of allocation to give you some of that downside protection?
You have to have downside protection for the reasons I've delineated. I think this is a manipulated market in some respects, given the Fed's purchases. It's doubled its balance sheet, and it's going to take it from $4.5 to $12 trillion by the end of this year. So I think that you do need to have protection. Ways to do that I've been citing for the past 3 months have been buying gold, and gold is today at record highs. So protect your positions. You can protect your positions while staying invested with the married put option, buying on dips and buying the out-of-the-money put options with a long duration. You can buy gold. It's at record highs. That doesn't mean it doesn't go higher, and more likely than not does. Buy tips, buy low correlated assets such as private equity, and increase your cash allocation. It's never a bad idea to take profits. I think that there's more downside risk than upside at the current juncture, and I don't think it would be a bad idea to increase the cash allocation.
Kathryn, thank you so much for joining us with your thoughts. As Kathryn Rooney Vera of Baltic Capital Markets. Thanks so much for being with us. Here's